So I think the first thing, once you've kind of made your investment, is to make sure you understand what you really own. Have you bought these shares directly from a selling shareholder, in which case, you actually own these shares? Or have you invested into some type of investment vehicle that ends up holding the shares, which is incredibly common in the pre-IPO market? I think it's the first thing you want to make sure you understand. Now, once you've got that figured out, you'll be able to log into an account, hopefully with a platform that shows you, yes, you hold these shares, or you hold this investment in an investment vehicle that holds the shares. That platform might allow you to get liquidity where you can sell that to somebody else on the platform. But for the most part, I think investors should go into this space knowing that you should be expecting that you might be holding this investment for many years until some type of exit event. So once you hold the shares, the value of what you hold could go up or down. That's a pretty typical construct, right? The only thing I would highlight is that because private markets aren't nearly as active as public ones, there might be periods of time where there's really no update to the value of your shares. And that's not uncommon. So a few things can impact fluctuations in price of the holdings of the pre-IPO companies you have. One could be a traditional funding round. So maybe you invest at the time when the company was worth $5 billion, and then 6 months later, the company goes and raises a new round of funding and it's worth $7 billion. Maybe it's worth $3 billion. That could be one trigger for new pricing or what your shares are worth. Another could be overall macro factors. Maybe when you invested at the company, its public competitors were trading at a 20 times multiple of revenue, but over time the market is contracted and now that company's only worth 10 times revenue. You would probably see a corresponding dip in the value of the private company that you invested in. Lastly, you could also just get intermittent news. Let's say the company has a new client or a new customer that's a big windfall for the company as far as a new revenue stream. That may increase the price of what you hold. Or in the other direction, maybe the company's subject to a lawsuit or a security breach. Then you might see the valuation of that company decrease. So much like publicly traded companies, you can see various inputs that may impact the pricing upwards or downwards. One thing that you should know about for most of these pre-IPO companies is that they tend to have two classes of stock. They've got common stock and they've got preferred stock. Common stock is usually the type of stock that's issued to the founders, the employees, kind of your general shareholders. Preferred stock is typically what's issued to institutional investors that kind of give the money to run its business. So you could think of this as venture capital investors, hedge funds, private equity investors, etc. Now, the big thing to know about here is that a lot of times the preferred stock, as its name might indicate, has more preferences and has more rights. So if you hold shares of preferred stock of a company, you typically have more flexibility or more inherent value in those shares than common stock. As an example, there's typically a clause that talks about a liquidation preference. And what that says is that if the company were to be bought and the value is not that great, the price at which the company got sold for isn't that great, the preferred stockholders basically get to dip in and get their money back first before common stockholders would get to do so. So just another reminder that as you take a look at each of these opportunities, you should be cognizant of the fact that most of them have preferred stock, which usually kind of sits on top as we think about it with the company's ownership table, and common stock, which sits at the bottom. And the last thing I'll call out is typically, not for every company, but typically, when a company does end up going public, all the shares kind of convert in the same way to become that one class of tradable stock on the stock exchange.